with the hottest topic in real estate, which is, especially in California, how do you make money in this stuff?
How do you make money in this stuff?
How do you make money? How do you make cash money?
Everybody wants to know.
Right?
Especially in California.
My buddy Scott Boyer's here. He has the answer for this. And so the conundrum has been, and we'll just kind of start with the obvious, market shifting in real estate. You can see it very clearly.
Yep.
Some buyers don't know yet because they haven't been in the game, they haven't looked, they really don't know what's going on. There's some people who are still out of the know in that regard. But if you're a home seller right now, or if you've been in the game as a buyer for a year or so, you've seen a noticeable difference in what's taking place. If you're an investor, which is really who we're talking to here,
yep.
You've been fighting with these super crazy low cap rates for years.
Right, and I don't see that that's really going to change because you have so many forces that are pressing on the investor in California that it really makes it almost an impossible task for them to make it work. Because most of them will rely on the fact of they're gonna cross their fingers on appreciation. That's the California game. If you're an investor, it's because in cap rates you have to kind of suffer and kind of suck it up and take what you get, and that becomes a problem when you're looking for mailbox money when you load everything into, well, but California always goes up, and now that is not true.
Yeah.
And so as an investor, if you're getting a little older, how do you take that risk and say, well, I hope it will?
Well, a lot of the investors who are making cash flow on their California real estate right now, they bought these homes or they've owned them for decades. Or, you know what I mean? They bought them in the 90s or the early 2000s, or at some point it was a foreclosure and fixed it up, and they've done something that was very hands-on.
Right.
It wasn't always passive. They had to do a lot of work. They bought it right. There's a lot of other factors involved.
Yes.
So there are a few people out there who are getting mailbox money in California real estate. These are also the same people who would have a lot of recapture if they decided to sell those properties right now, and that's probably why they don't do it. But for people who are trying to make new investments or to 1031 stuff, or they're trying to figure out, all right, well, do I get back in this if I just had a good exit? Because the appreciation is what it's always been about. In fact, for years, and I remember leading up to the crash of a decade ago.
Yes.
People, that one. People were like negative $1,000 a month in rent and cool with it.
They were all fine with that, and because it was always based upon the premise of the property will appreciate, and at some point the ship will pop back up above the water, and I'll be okay.
And until it doesn't.
Until it doesn't. And that's the thing, is that from a strategy standpoint, that's where I always want, and in real estate I've always looked at it as that I need the odds in my favor. I need everything possible to where if I'm going to be in this game, I don't want to have a very narrow path to success in what I'm doing. I want some breadth for mistakes, market shifts, things that I can't control, but it's not going to change my ability to make my money. And that's, to me, is where the opportunity is, even for California investors now, is that you look at the cap rates, it's like, how do I double that up and get to 10%? Because that's kind of a crazy number when you think about, if you're like, what?
Yeah.
What'd you say?
10%. No, I mean, no joke. People will come in here, pitching real estate properties that are investment properties, and they're saying, hey, it's a 4.5 cap.
Right. Oh yeah.
And
they're high-fiving, and isn't this awesome?
And it's true. It is really good for around here.
Right. For
around here being the key thing.
Well, but when you look at the pressure of the inability for the renters are not making the same money, so the owner and the landlord has to keep rents at a place to where it doesn't press, because it'll outstrip affordability, and we see that now. When you look at kind of the ratios, I mean, I see these $500,000 condos, and they're asking, they're happy to get $2,800, $2,900, just because, and that's really, they should be able to, in the market, you would say that they should get $5,000 a month for it, and they're not, and they can't, and so all that pressure. I mean, Southern California is the most expensive for living, it's most expensive for buying, and then we get into the wonderful state of California and how they look at taxes and things like that. And all these pressures continue just to put a lot of weight on the average investor of saying, I don't know that I really want to, or I don't know how to, or when I look at it, it's just like too much risk, not enough in my favor, and then they just kind of like, well, so I guess I'll just throw it in, keep it in my IRA and cross my fingers, what the market's going to do. Now, for the last few years, that kind of was okay. Now that's even changing.
Stock market.
That's even changing, because the stock market isn't, the safe haven of like, well, real estate's too complicated, or it's too this or that, so I'm going to go over and I'm going to just leave it in the market, because apparently that always goes up too.
I'm going to leave the stock market alone today, but I'm going to put the final nail in the California real estate coffin with this one story, and then we're going to talk about solutions.
Yeah.
So, a really good buddy of mine is up in Long Beach. He and his partner, they buy multifamily real estate, and that's their big thing, mostly in the LA area.
Right.
Huge deals these guys are doing, $10 million property, $12 million properties. Last time I was up there, I saw him. He said they're in the process of closing on one, looked really good. And I said, tell me about it. How good does it look? And he's like, well, it's like a 5 cap, so I feel really good about it. He was super excited. This is a $10 million, I think, 55 unit property in Long Beach. And so I was just like, wow, that's bonkers. He's super stoked about this 5 cap, and it's an old place. Like, it's not like someone just refurbished the thing or anything like that. It's, probably needs maintenance. There's other things involved. You have upkeep, and you've got to take all that out of that 5. And he was stoked. So that's the final nail I'm going to put in the California real estate coffin, because what you've done and what you've been able to do, and you and your partners have done, is sort of crack the code of like, well, hey, you can still live in California. Listen, everybody wants to live here.
Right. That doesn't mean your money has to be here. I mean, think of it this way. If you knew buddies in the financial industry and they were all had California-based mutual funds, and you're like, that's all I'm going to invest in, just because I just do everything in California. But there were much better ones elsewhere. But you're like, no, I like California. You kind of look at it and say, well, wait a minute, it's about your money. Your money doesn't care where it's at. If you think of your dollar bills as your employees, you just want your employees to work hard for you. It's not really necessarily, because they get up every day and they do what they're told, or they just do whatever it is of where they're at, and sometimes that's part of the problem.
Mm-hmm. So in this case, how does someone get 10% cap rates plus on investment real estate?
Well, number one, it's the investor needs to be able and be willing to look outside the state lines. I just think that ship has really sailed for the average investor, because again, a lot of the ones that I interact with and talk with is they'll start with 1 or 2, and then they'll kind of scale from there. So sometimes they are just starting out, but there's a lot that also are looking at that 1031, and they're like, well, I sell this for $1.2 million. Well, I can trade it out, but I'm just trading out one headache for another. I'm kind of right back in it. I'm on this treadmill. So number one, I believe that you have to go outside the states and get out of state, because that changes the first dynamic dramatically. Now, then from there you have to look at, well, where? It's a big world out there. Where do I go? So that's the second thing, is that you need to go into areas to where there's a couple things. You need to look at how the market responds to downturns in the economy. So you go back and you can look at the last downturn. How well do those markets do? Because again, I can go find good cap rates in a lot of places outside of California. But we also know that if markets ever take a tank or a dip the way that they did, it makes exiting really difficult. I mean, you're gonna be underwater, and we know how many people handed the keys over and just said, this doesn't work. Or all of a sudden the streets are blank and there's no one, job market's changed, and there's no one to actually rent your property, and it's underwater.
Solid job market.
Right. So you have to look at the actual market and choose wisely to make sure that you've got the ability for rents to be able to perform on a long-term basis. So you look at the economy and you look at their industry and the breadth and depth of it, not just where you can get a better cap rate, because that's not that difficult. But then on the one-offs or whatever the case might be, then the real thing is the systemization of how they are running those properties and how what you can step into. Because the other part is, if I find a property in Arizona, or if I find it in Texas, but I want mailbox money. So I don't want to be a landlord. I don't want to have to be, I can set up something for them to auto debit my, for the rent or whatever the case might be, and I can act like I'm a landlord. But then you got to deal with who's going to take care of it. Okay, so you go call up and you find some. The other part is, did you find a good one? Or is it really Uncle Eddie that's really acting as, a property manager, and it's not going to really work out very well?
He's going to call you. Shitter's full.
Exactly.
Right?
So you've got to look at all.
That was my next question, though, because I'm interested. It's interesting to me. The idea of being able to say, hey, you can take money, park it in real estate somehow. I mean, I've heard of REITs, and things like that, which this doesn't sound like that. No. But I've heard of things that are similar, where people have said, hey, there's returns, they're very solid. It's in real estate. It's just like buying an investment property, but it's more hands-off. And what you're saying makes sense. Hey, go to a market outside of California. I've heard people talking about Idaho and Oklahoma and all these. I've heard of these things for years. But again, it's another thing where it's like, yeah, sounds like a full-time job. I'm going to have to figure out who property managers are. I'm going to have to scour the market to make sure I'm getting a decent deal. Someone's going to have to look at the property and make sure that it's not a piece of crap before I buy it. Someone's going to have to find a renter. Someone's going to have to collect the rent. All that sounds like a lot of work to me.
Right. And that's the part where you, as an investor, you want to basically get something that's already done for you. So you walk in that it's already rented, it's rehabbed, it's cash flowing, and next month you've got mailbox money. But you also in a system that has been long proven. So it's things like this. So you buy like properties to where so that you know that you're going to be able to buy the same kind of parts in volume. So when you have things that break, you've got it on the truck, and you got guys that are going to be able to know exactly what you've got to do. It's kind of like the Southwest model. When one of the things that makes them so profitable is that all their planes are the same. So when something breaks, they've been able to buy volume of parts. It's not like you look at a lot of airlines and they've got 10 different kinds of planes. So one thing is that you have a system to where you're buying numbers. So the thing is, if you deal with properties that are all basically the same, the rock solid ones, things that you put wood, you put the linoleum floors in, you do everything the same to where it has longevity, it's fixable, you go in and you can deal with all of the mechanicals in the same way. That gets systems down to where you're really managing at that level to where it gives the investor what I call a sleepability factor, where they know that, okay, this thing is rehabbed right. I have very low risk of anything major because of how it's done up front. And we're talking, I would say, we're 900 doors in, the guys that I work with and I even have my own properties with, and depositing $500,000 a month into investors' mailboxes. So it's we've got that to that point to where it's not where someone's trying to figure it out. So the systems are down to where they're specialized, and the specialization in the management is, I would say, is the secret sauce. Not just going out and finding a property, because you can do that outside the state lines fairly easily, but there's so many blind corners for an investor that they still have risk that they should want to cover, because at the end of the day, it's about opening up the mailbox and having that rent or just auto deposit, which that's what
I think that's much easier.
Right.
We should stop calling it mailbox money and we call it ACH money.
Right, exactly.
So then what you have then is a way for like an investor like me to participate in what you've already been doing.
Right.
So how does that work? I mean, how do I get, what do I do? What do I look at? How do I figure out if I can get involved? What do I need to get involved?
I think for most, a lot of it, it's more just of a conversation, because again, it could be someone that says, I've got IRA money, can I use that? The answer is yes. So
okay, so let me give you an example then.
Yep.
Let's say I have $100,000 in an IRA. Is that enough?
Sure. Oh, out of state, yes. Here in California, no. That's not enough in California.
Okay. What would it be enough to do?
Well, again, if you're going to finance, you could actually finance some properties, and you could probably get 4 or 5.
You have 4 or 5 properties. Oh, if you finance.
Correct.
Use the IRA as down payment.
Correct. So, and if not, you've got easily one property. So that's a great place to start. Cash, boom, and you're off to the races. And a lot of investors start like that. I did that. I bought one, and I bought another one. So sometimes it's kind of like you slowly do it. But it could also be the one that's I've talked to investors to where they've said, look, I've got this house and I want to sell it and travel the world, but I'd like to have cash while I'm traveling. Well, so what do I do? Well, let's transfer that out and 1031 it, and we'll take the $1.2 million, and you could get yourself 10 properties.
Your phone's already ringing.
There it is. So it makes it to where all of a sudden that you can go live the life you want. It doesn't matter whether as you get in your 40s and 50s, all of a sudden, the dynamic changes, and you really want something that is that simple. So I see the IRA money flowing in. I see the 1031s, and I also just see the cash buyers that says, look, I can, and I get it, because I want something that I can count on, but I'll just start with like 1 or 2.
Okay. Well, let's continue that example, because I want to get as granular as I can with this, because I know there are going to be a lot of people who want to know, how do I get 10% cap rates? I mean, right now, as you know, investors are struggling. 3-4%, very normal. My buddy's stoked on a $12 million purchase for 5.
You talk to him.
A 5 banger, you know what I mean?
Right.
And so the question is, I have my $100,000 in my IRA. You said I can get 1 property. That's what I'm interested in. I don't want to finance. So I just want to buy 1 property. What property? How am I getting a property?
So we've got the set of we've got inventory. You can go look at the numbers. You find what fits. I'll even have some that I'll even. I've seen we'll fly them out to our location. If they want to go touch and feel it and see it, that's fine.
So it's a property that already exists.
Yep, already rehabbed.
It's already rehabbed.
Are already done. So they're already bought. We own them. It's rehabbed. It's done, and
it's rented.
It's rented.
So it's rehabbed and rented.
It's rehabbed and rented. So you don't have to worry about that.
Okay.
All those pieces. Really, it's just kind of you're turning on the switch.
So in my case, let's say we're going to make numbers really easy today. So I have $100,000 in my IRA. I find a property that's $100,000.
Yep.
And it's renting out for $1,000 a month.
Yep. Maybe more.
Okay. Let's just call it $1,000.
Sure. Easy numbers.
Easy numbers today. You guys have this on your inventory list.
Yep.
I say, okay, I want to buy this out of my IRA, which you said I can do.
Sure.
So it's inside my IRA. The money, then the rent, that $1,000 a month, just goes in the IRA.
Yep. Exactly.
Every month.
Every month.
And I don't have to do anything.
No.
I just pick the property. This is what you're saying.
Right.
It's already rehabbed. It's already rented.
Yep.
It's ready to go.
Yep.
I pick the property. I buy it through the IRA.
Right.
So I own the house.
Correct.
The house is mine.
It's yours.
But you guys manage everything, and the check comes into my IRA.
Correct. And some of the leases some are 2 and 3 years, where it's basically done for a multi-year contract that's already set.
And what happens when that lease is up, for example?
We'll be on top of that way ahead of time.
So you handle that?
Yes.
So I really don't have to do anything?
No. And vacancies, 2%. I mean, so again, there's always those things, but you've got such a wide berth of, when you get a couple of properties, the nice thing is that, you've got a lot of latitude that even if you've got a turnover and you've got it where it's being, someone leaves or a little sooner or whatever the case might be, or you just got a bit of a break. I don't see it a lot, and that goes back to where you do this is so important for that purpose. Because if you do it in other places and the economy shifts, all of a sudden vacancies turn into 4, 5, 6 months. Well, that could be a problem for mailbox money or ACH money. I mean, that's.
So where are we buying these properties? I mean, we're not talking about like Mexico or.
No, it's in the Midwest is just where we've done it, and this is where it's at because it fits all that criteria, and I don't see that that's going to necessarily change. I can I can look at other areas, but I would say, to me, it's always better to do something in some place and do it well. And so how we buy the properties and how it's done to where we're buying the right kind of properties, and there's enough inventory for us to do that for our investors, and the economy is correct, and it's set up to where we have everything, where we're not dealing with 12 different locations and 12 different management companies and us trying to handle all that. We just do one thing really, really well, which is why I started when I bought. It was like, okay, that makes sense. And the partner that I work with, this is will be our fourth venture together. He started it out, and I kind of watched, but it became obvious is that this really is an unmet niche. Not so much about real estate in general, but where you really have all the boxes checked of how you run the systems and how you make it to where for the investor it is a truly turnkey, where they're like, I don't want to get into all the details. I would just like to have it to where I can, it's bought. I don't want to deal with rehab and find contractors. I don't want to deal with that out of state. I don't want to deal with finding a renter that's out of state. I don't want to have to try to find and hire the right management company that's out of state. Because again, if you think about it, a lot of what I've seen from additional properties being bought are current clients. Which means when it's kind of you get in and you taste the cooking, you're like, oh, this is kind of good. Can I get another plate? Mm-hmm. Can I have some more, please? And so that's and I get that, because out of state is enough of a little mind shift for a lot of investors that it makes sense to sometimes tip your toe in the water and say, let me start with one or two and let me see how that works, and then we grow from there. And that's the typical path of what I've watched happen over the years.
Pardon me. Makes sense, and seems too good to be true. I mean, it just so you've got every box checked, so simple. But you say you've done this 900 times?
Yeah, it's over 900 doors that we've done this. So again, we're not seeing if we've got the right pieces. But as an investor, that's what you want. I mean, so when I started investing in 2008, that was new for me, and so the systems at that point were still being built. But I also had a relationship, and I knew these guys, and so it was a little bit easier for me. Now, 900 doors later, it's kind of like, okay, can we get beyond that conversation of like, we're not practicing. They practiced on me. And the funny thing is, it worked out great. I mean, I had low vacancies. My rents were solid. I had a great experience with the management company. They just really, even then, they were on the right track. And of course, you always you just keep getting better, and that just makes it better for the investor to where they're like, okay, now maybe out of state isn't as scary as it might sound, because the inclination is always to want to stay in your backyard for anything. It's just it's more comfortable. But that doesn't necessarily mean what's best for your money. But if you're going to do that, you got to make sure all those boxes are checked, so that I always call it so you can sleep at night and not worry about something 2,000 miles away.
Well, it's really a big deal for people who are real estate investors here, who have seen maybe they did hit the lotto, and they were hoping for the appreciation, and they got it, the past 6-7 years.
And there are those like that, absolutely.
But they're sitting here going, okay, I've made it there now. I guess I have to sell, right? Because this is what I've been waiting for. I've been breaking even on rent.
I've seen house values drop at the rate of what you could have bought another house out of state for what it's dropping here.
Yeah.
It boggles my mind, because once that's gone, it's gone. And maybe it comes back, but the timeline of for the eggs to be in that basket and the pressure that's going to be on your cap rates in that time period, it just doesn't have to be that way. It just doesn't.
Well, the thing that I like about it is the idea of being able to diversify. So let's say I bought that property and I've made some money on it, some equity, and I can sell it now and have $300,000 or $400,000 of money. I need to 1031.
Right.
But I'd rather not put it all in one basket. Mm-hmm. and I can go and maybe buy 4 or 5 or 6 houses out of state at a much higher cap rate, all cash, so I don't have a loan.
Correct. It's just you're just trading out so you don't get taxed.
And then boom, I can get that cash money coming in.
Correct.
And it can be coming into my IRA if I want it to. If the money's from the IRA, it can go into there.
Right.
Which is really nice. But let's say I'm not an IRA investor. Let's say I'm just a cash investor.
Yep.
Same. Doesn't have to be IRA.
No. It's just all those doors are available. Just knowing of where an investor can come from. It can come from someone that says, I don't have the skills to be in the market the way it is, in the stock market. And I need to make sure that I've got consistency. So they've got this IRA, it could be an old 401 or whatever, and they're like, I would be more comfortable looking at real estate, but I got to figure out how to do that. So we see that a lot of properties being purchased through that avenue. And you get the ones that have real estate. It could be family, or it could be an investor that's saying, maybe I should actually look at trading this out. And so a 1031 can come from multiple different kinds of scenarios. And then you just have the cash buyer. And then you also have those that are really wanting to get into it, and they're starting out with a little bit less money. And so we'll actually have an occasional one or two that'll actually finance.
And so the house is mine. I own the house.
Yep.
And if the house goes up in value or something like that, I sell it. I make that profit. I can sell it whenever I want. Basically, I just put it on the market and then exit that way.
Right. And again, the trade-off is this: if you're in out-of-state real estate, the trade-off is cash flow for crazy appreciation. And to me, I would say that fits so many investors that look at it and say, look, I can be tagging 10%. I don't need to in 10 years, if I want to cash out. If I've got some appreciation, great. But I've had 10 years of really consistent mailbox money, and that's what I'm looking for. I'm looking forward to where I've got, because again, bills tend to come every month.
Yeah.
So for most investors,
Fact.
and if something's not working, or the market takes a tank and you've got to rob the golden goose, that really can weigh on a person of how they look at their future, and they look for those safe harbors of where can I really get it to where I'm not feeling that I'm putting my golden goose at risk. And this is, to me, is one of the best ways an investor can do it.
Well, let's answer Ross's question here. He says, what company is this guy from? That's a good question. I noticed you brought a book in here today too.
Yeah, so my good buddy Michael Drew, he's out in California a lot, and so I'm handling more down here in San Diego. But outofstate.com is kind of where I've branded it with him. He has his brand. We're kind of a co-branded Real Estate Done For You, because the idea, it's done for you, and so that's who we are. We're just guys that have put all the pieces together and want to tell our story and help investors that are in that same boat that I came from, and that are looking for some answers.
The same boat that a lot of real estate investors are in here in the state of California, all over the state of California, because it's expensive everywhere, in case you haven't noticed. Very, very interesting topic, and more to come on this. This is the first conversation we're going to have about this, because I know a lot of people are going to want to hear more. Scott, thank you so much for coming in today. It's great to see you, man. Really appreciate your time.
You got it.
You are now officially smarter than everyone else when it comes to investing in real estate, not in California. Not in California. You want higher cap rates, that's where you got to go. And Scott Boyer is going to be back to tell us more about how you can do that in future segments. For now, click the information below if you'd like to get more info from Scott, and we'll guide you to the right page for that. And of course, today we've got more coming up here in Smarter San Diego. We've got listed live later today as well, where we give you a guided tour of the hottest homes for sale in San Diego. So stick around for more of that later.